Good evening, everyone. As introduced, I'm Andrew Dennan, Chief Financial Officer of Coro Energy. First and foremost, I will draw your attention to the disclaimer. As the gents mentioned earlier, this will be available to you online, so take your time to read through that. First, I think it'd probably be useful to start with a short introduction to who Coro Energy are, how we came about, and what we're doing. Coro is a relatively new company on AIM. We admitted to trading in April of last year, raising £14 million of new equity in conjunction with the consolidation of two small Italian portfolios. The production portfolio of Saffron Energy, which has concessions in the Northern Territory of Italy, along with the Italian portfolio of Sound Energy. Combined, that gave us some scale in Italy, which is proving itself to be quite a difficult country to grow in terms of bureaucracy. However, actually, it's a very fantastic country to be in once you're in operations and you're actually producing. There's a good fiscal regime in place, there's easy to monetize your assets, and a very strong gas price there. What that platform, however, did for us was give us an operating platform with over 20 years of experience, operating onshore gas development, as well as having drilled high-pressure wells, which enabled us to go over and launch our growth strategy in Southeast Asia, credentialising ourselves with the host governments and being able to make the steps that we've made since April of last year. So we're focused on Southeast Asia, where we see a supply and demand imbalance, very strong local gas markets, even better than Italy, and also a great opportunity for us to scale our business, find some scale, and we'll come on to how we've achieved that as well. So as I mentioned, in April of last year, we admitted to trading as Coro Energy. We raised £14 million, which was heavily supported by institution Lombard RDA and CIP Merchant Capital. We also have Conrad Energy, who are a 7% shareholder of ours, pursuant to the most recent transaction that we announced. And the balance of circa 50% is held with retail investors. So since we initiated our Southeast Asian growth strategy, we've done our maiden deal in Indonesia. We followed that up with an entry into Malaysia, and most recently, our second deal in Indonesia. We also had an opportunity of, So in terms of our board of directors, we're spearheaded by James Menzies, who's our Chief Executive Officer. James was the founder and CEO of a company called Salamander Energy, which was on the main list here in London, before it got taken over by Afir Energy for $850 million enterprise value transaction. James is a geologist by background. He spent the best part of the last 3 decades focused exclusively in Southeast Asia. So in terms of his opportunity, relationships, and ability to sniff a deal, he certainly is second to none. James Parsons is our non-executive chairman. He's the CEO of Sound Energy and non-executive chair of Echo Energy. We also have Fiona McCauley on the board as a non-executive director, who's also the chair over at Independent Oil and Gas. And Marco Fumagalli, who represents the interests of CIP Merchant Capital, and he also sits on the board of CIP Merchant Capital's investment vehicle, which is the entity that holds the equity in Coro. Now, just to touch on James Menzies, as I mentioned, he was the founder of a company called Salamander, which got taken over by Afir Energy. It's not in this presentation, but if you look at our news feed, you will see that earlier this year we had an attempt to take over Afir Energy as well. This was quite a fortuitous opportunity. The company got bid for by a company called Medco on New Year's Eve, in an all-cash transaction of 55 pence per share. We were working with a tier 1 investment bank to bring about a counter bid, which would have been circa 40p in cash to those existing shareholders of Afir, and then a deferment and a roll-up into new equity in Coro. Unfortunately, we were the last horse in the race apart from Medco, and because we were using financing to do a leverage buyout, we would have to use a scheme of arrangement to make the acquisition successful, which would always require at least 75% of the votes to proceed. However, the night before we were about to announce our bid, we went to see the largest shareholder, who I believe was an ARB fund, who came in and only acquired his position post Medco's initial approach. However, he did own 22% of the company's shares. And in terms of our bid being part cash and part shares, I think, next phone call after our meeting was to Medco, and they increased their all cash bid to 57.5p per share, which at that point in time he gave an irrevocable undertaking. So the likelihood of our ability to be able to transact and proceed, getting that 75%, became very exceptionally unlikely. So we had to buy onto the race there. But that just serves to give you a purpose of as a small cap company where we are today, some of the ambition that we've got moving forward, and in terms of that portfolio, certainly the magnitude of what we would have been able to achieve there. Now, coming back to Southeast Asia, which is our growth strategy, why are we there? Well, what we see is a supply shortfall. This is some data here that we've put together from data received from SKK Migas, the regulator over in Indonesia. And we can see that the existing supply is in decline. Future supply, which is existing discoveries which are coming on stream, has a nice bump there, and our assets are included in that bump. But there still remains a supply shortfall. So there's an upward pressure on gas prices here. And we already have a buoyant market with $5.5 to $8 per MMBTU in East Java, Indonesia. And over in Singapore, where one of our assets has access to that market, we see gas prices starting from $8 going up to $11 per MMBTU. This macro picture is verified by third parties. What you see on the right of that screen there is data produced by Woodmac, who are very respectable in the industry. And again, we see a supply-demand gap in the top chart there. So there is a requirement for new discoveries, a requirement for new gas to come online, and again, verification of the upward pressure on gas prices. And here we see, just below that, on the second chart down, where Woodmac believes that shortfall is going to be made up from. And if we have a look at what that circled area represents, we see new gas discoveries and uncontracted pipeline. So that's the area where we see an opportunity for Coro to play a role. Uncontracted pipeline would be discovered resources that are yet to be commercialised, and obviously new discoveries, we all know about exploration. So we see an opportunity set here for a small cap E&P company to come in and play a very proficient role, set against the macro picture that requires people like us to be coming in. Our strategy is what we term a hub strategy. So we're not big E exploration here, we're small E at best. Our preference is to get an asset where there's an existing discovery. Fallow discoveries, there's many that we can talk about, and I'll come on to that on my next slide. But in buying fallow discovery or an existing discovery, you have a safety net there. There is an asset or a resource that we have a strong belief that we can commercialise. So we have a forward trajectory in any event. But often or not, what you find is that the smaller the fallow discoveries are often very much larger than what people initially think. And James at Salamander has proven this many times before. In fact, James Menzies did a deal with James Parsons 7 or 8 years ago to buy sound energy out of an asset in Indonesia where Salamander were operator. In doing so, they thought at that time it was about 250 BCF discovery. With small E exploration, it turned out to be 800 BCF, and that's still chugging away and was one of the main backbone assets of what was formerly Ophir and now is Medco. So we're looking for existing discoveries where we've got a resource in the ground that we have a strong belief we can commercialise, where we can see opportunity sets to do small E exploration, drill the next bump along, not taking frontier risk, but if those types of opportunities come in, they're massively value accretive because you can tie that back to your existing infrastructure and then pick up the surrounding acre around that. And what we find in doing that is we get an enhanced technical insight because we're working the same geology, the same rocks, operational flexibility in terms of how you monetize the assets, in terms of how you make those discoveries, and the financial synergies that come with being able to tie back to infrastructure or other equipment. So from our perspective, we're looking to build a portfolio of 4 to 5 of these hubs. And in doing so, what we will then have is a portfolio, hopefully of a large operated equity participation, but of assets at different parts of the maturity curve. So we'll have we aspire to have some production which throws free cash flows off. We use those free cash flows then to explore, develop the less mature elements of the portfolio, and then we've got an engine that we can continue to grow, self-sustain itself until you get towards a level of 20,000 barrels of oil production a day, and then you're a real target for a major or an existing large company to take you out. So that's the journey that we're following. In terms of fellow discoveries, these have been a great source of value for independents in the region. This slide here, we're showing you when discoveries were made versus when they were commercialized. And what you can see here is that the entity or the company that makes the discoveries, often or not, it was very rarely the entity that actually commercializes the resource. In fact, in some instances, they can stay there for 30 years without being touched. So there is a great opportunity for us to pick up existing resource that's in the ground, that we have a strong belief we can commercialize, but also not taking the frontier at big E exploration risk. Now, our first transaction was in East Java, Indonesia. We picked up a 42.5% interest in the Bulu PSC, which contains the Lengo gas field, which has been independently certified to have 359 BCF of 2C recoverable. From our perspective, that's brilliant because it's a very simple operation to bring that into production. Four wells tied back to an unmanned offshore platform, 60-kilometre pipeline back on shore. There is 12% CO2 in this gas, so it will have to be a thick steel carbon-lined pipe. But there's a very buoyant gas market there in East Java, petrochemicals, power gen, fertiliser. So we have 6 MOUs signed with potential gas buyers, which we hope to convert into a gas sales agreement later in this year. The asset itself lights up on seismic, as you can see, so it's very well defined. We've had 2 wells drilled here, which have both been cored and flow tested at 13 million scuffs a day and 21 million scuffs a day. So we know it's a commercial flower. And we acquired this resource for 10 cents per MMBTU, paying the vendors $8 million in cash and up to $4 million in shares. We have development costs of circa 80 cents to $1 per MMBTU, and then we'll have operating costs of circa $1.10 per MMBTU, and that's set against the backdrop of a gas market which, as we spoke of earlier, is $5.50 to $8 per MMBTU. So there's a lot of margin there for us in terms of developing this and commercialising this resource. This one itself doesn't have a great deal of prospectivity on the upside, so we're looking at opportunities around the acreage around here that can dovetail in. There's quite a few that meet our criteria and synergies, but as we spoke of, very simple development, 4 wells tied back to an unmanned platform with gas piped onshore. We have an approved plan of development in place with the Indonesian government. The gas sales agreement is the next milestone that you should hope to see us sign, and then we can move towards FID and hopefully bring this asset into production for 2021, maybe slipping to early 2022. The third transaction that we've announced, and I'll come back to the second shortly, is another asset in Indonesia. We acquired a 15% interest in the Duyung PSC, which contains the Mako gas field. Now, this is in the West Natuna, which is actually the asset lies adjacent to the West Natuna transportation system, which is the large pipeline infrastructure that runs through Indonesia and passes actually by Singapore, which is where we have heads of agreement signed with the gas buyer. The Singapore market is probably the best market in Southeast Asia to be selling your gas to. They import all of their energy. So we see gas prices there, as we spoke of earlier, $8 to $11 per MMBTU. Again, what we have here is another asset which lights up on seismic, and that's due to the fact that it's only 400 metres below the mud line. So it's very shallow gas here. We also have 4 penetrations through the gas field, so we do know there's gas there. The Mako South well was cored and tested at 10.8 million scuffs a day. So again, we know that we can flow commercial gas here. And these shallow fields aren't new to the industry. We're not reinventing the wheel. They are out in the Netherlands. They've been operating for 20 years now. So it is a relatively vanilla operation, quite similar to the Bulu PSC. Here we've acquired our 15% interest for a total consideration of approximately $15 million. That is paid as $2.95 million in cash to the vendors, plus $1.85 million of Coro shares valued at 2.35p, which are locked up until we have the results of the upcoming drill program. We're then also paying $10.5 million into the program to fund the upcoming drill program. So our money is going into the ground here, not going into anyone's pocket so they can go and spend it elsewhere. Only 2.9 has to go there. 10.5 of it goes back into the ground here, which is much preferred as to how we would like to transact with vendors. We have a biogenic gas accumulation here. And in fact, back in the 90s, our CEO was responsible or on the drill team for the Chakalang well, which is this well here, targeting deeper horizons. They actually knew that this gas field was here, but they actually viewed it as a hazard back then because of the shallow nature of it and the technology at the time, and were concerned about a potential blowout. Having drilled this though last year with the Mako 1 well, we now know that that's not the case. So here we have 276 BCF of 2C resource, independently certified by Gaffney Klein. And this, in end of Q3, beginning of Q4, we'll be drilling here. We're drilling 2 wells. One will appraise the southern end of the field where you can see there's no penetration, so drilling down here. And the other well is up north, which will be Tambak. Now, Tambak, so both of these drills will appraise our existing gas discovery. But in the north, we'll be deepening the well to test a 250 BCF mid-case prospect. Now, as I said, here we had Mr. Menzies back in the 90s drilled Chakalang, which is this well here. You can see if we look at the structure map here, you've got a high here, a high here, and a high here. This one and this one have both been drilled and they were both dry. Now you might say, why then are you drilling here? And the reason why we're drilling here is because the current operator did something smart. They took the amplitude extraction and laid it over the structure map. And what you can see is in this perforated line here, the amplitude lights up. And that's telling you something. There's something going on in this middle bump here that wasn't going on in either of the other two. So we have a quite high, in the context of exploration, chance of success here, estimated to be at 45%. And if this came in with a BCF range, mid-case of 250 BCF, we have the opportunity of potentially doubling the existing resource. Now the incremental cost of testing that is an extra 2 days drilled for us appraising the main field anyway. So that's the type of exploration that we like. Lower risk, safety net is we're appraising our field in any event, so we're going to get the right data that we want in pursuing that. But if it comes in, the incremental cost of that additional 2 days to double the size of the resource would change how we market the gas and how we develop the field. So we'll be drilling that this year. This transaction we funded with the issue of a 22.5 million euro bond. That euro bond, half of it was subscribed for and underwritten by Lombard Odier. CIP Merchant Capital also participated in that. They think they subscribed for 4 million euros, and we brought in new institutions as well who took up the balance. So we're fully funded to complete this transaction, which has gone through, complete our drilling commitments for this year and through to next financial year and beyond. In December last year, we announced our initial entry into Malaysia with a joint study with Petronas on Block 2A, which is offshore Sarawak. That Sarawak's been in the news recently. There was a 2.5 TCF discovery actually just southwest of where our block is. And also the Bintulu LNG plant lies here offshore here. And that's the second largest LNG plant in the world. And again, that's been in the news or in the industry press regards facing potential shortfall. So the macro picture here looks very good as well. This, however, is off strategy for us. This is big E offshore exploration, which isn't what we primarily want to be focusing our attention and resource on. However, we have been knocking on Petronas' door. We see Malaysia as the great opportunity and fairway for Coro to really propel itself. There's 174 fields there which are vacant and not allocated. There are very little independent E&Ps there. There's very few at all. And that's a result of the high standards and the high barriers to entry to get into Malaysia. And that's important as I go back full cycle to Italy and the credentials that gives us in terms of 20 years track record, having drilled high pressure wells and having developed gas fields. So expect to see us do more in Malaysia. There is a discovered resource bidding round coming up later in this year. James Menzies apologises he can't be here tonight, which he had intended to be, but his trip to Asia has been extended. We met with Petronas last week as well. So Malaysia is very much a key focus for us. Despite the high barriers to entry, we think there's a real good opportunity set for a small cap player coming in. So just go back to our portfolio here. So in the last 18 months, we've done 3 transactions. We've taken our initial Italian platform, which had 30 BCF of 2C, 2C reserve and resource. Our Bulu transaction saw a 500% increase in that to 184 BCF, or approximately 32 million barrels of oil equivalent. And post the Duyung acquisition, we now have approximately 40 million barrels of oil equivalent reserve and resource. And we've also added some prospective resource with the 2 prospects that we have there. In terms of news flow, the Duyung PSC, we are drilling end of Q3, beginning of Q4 with 2 back-to-back wells. They'll be approximately 30 to 35 days each. In the Bulu PSC in Indonesia, East Java, we would hope to achieve a gas sales agreement by the end of this year. And then we can move to project final investment decision and begin the development of that field as well. In Malaysia, we're completing our joint study with Petronas on Block 2A. We've seen some exceptionally interesting data there, despite it being non-core or off strategy. There is some very exciting stuff there. So expect to see us mature that joint study into a PSC. And off the back of that, then we can be a lot more vocal about the data sets that we've seen there, the information that we have, and the opportunity that we'll be playing for. And then additionally, Malaysian business development is continually ongoing, as well as in Indonesia, but Malaysia is where I'd hope to see us do more business sooner rather than later. And that's the key message for us. We are very much a business development unit at the moment. There is a great opportunity in Southeast Asia at the moment. There's rotation of majors out, which creates opportunity for small and mid-cap independents to replenish their exit. But that window is closing, and we've seen a lot of transactions going on. I think Medco and the AFIA serves as one illustration. You've had a PTT taking big positions in Malaysia, OMV coming in with the change in guard in government there as well. So that window is closing. It's for us to get after it and complete transactions, but we're very cognizant of selective order and making the right decision. So yeah, I think in summary, we're a tenacious team that have raised money from institutions. We're fully funded for all of our operations for the next 12 months and beyond. And we are heavily involved in BD, so expect to see more from us soon.
Okay, so questions for Andrew. Quite a lot of ground covered there. One at the front here, Donald.
Thank you very much. With respect to Indonesia, I noticed they were offshore developments. Have you looked at onshore developments as well?
Yeah, we've looked at a couple of onshore opportunities, production and development stage. Onshore can be difficult, principally because you're hacking your way through jungle, mountain terrain. That takes time, adds costs. Mr. Menzies would profess to that, having developed Kalimantan, which was the asset he bought James Parsons out of. There were time delays operating onshore just because of the sheer nature of the geography that they had to, the terrain that they had to work through. Offshore has environmental issues, which are obviously naturally in place there, but it's pretty simple stuff. As long as you can get those approvals and the environmental ticked off, there's less operational challenges and issues for us, or in our opinion, to be able to have a seamless operation.
The biggest handicap or challenge for overseas companies in Indonesia is a regulatory authority. So what are you doing that's special?
In terms of the regime over there and the regulation over there, that's going through change at the moment. So we're seeing a switch from the traditional cost recovery production sharing contract to the gross split contract. In terms of economics, we're actually seeing an improvement in MPVs despite maybe a slightly increased time to recover your initial capital. In Indonesia, though, you need to be careful who your partners are. That's where you need to tread very carefully. There's a lot of fallow discoveries and existing production that are owned by indigenous Indonesian companies, and often or not you see that they've done nothing through the 5-year term of their initial contract, and then there's a mad scramble before it sort of gets taken away from them for them not completing their commitments. There's been resource nationalisation as well, more in the mining space than the oil and gas space. Indonesia, let's not forget, we're the pioneer of the production sharing contract. That was the first country to bring the PSC out. So oil and gas industry is very much the backbone of Indonesia. They understand E&P, their investors don't. Their investors like service companies, but they don't take the E&P risk. But in terms of operating there, we've got a CEO who's been in the region for 30 years, who's grown a business. We have special advisor to the board, former director of the board is Ilham Habibi, who was the son of President Habibi, who helped take the country through technology revolution. So he helps steer us or guide us in terms of any issues that we want to verify or double check in terms of who we're partnering with or how we're navigating forward.
Thank you for that question. Anybody else? Well, just probably time to take one more from the floor, but while we're thinking about that, can I just ask you, obviously at the moment, the investment environment for oil and gas is more difficult. The institutions are concerned about sort of future targets, legislation, about renewables. How comfortable are you with the environment? You'll be able to raise the sums that you need, and being on AIM for that matter?
Well, our assets are all gas assets. So we see gas as the transition fuel to a bridge between oil and renewables. There's a huge upwards pressure on gas prices there because of the supply imbalance. So we don't see gas being replaced imminently. Certainly our projects will play a part in helping recouple that demand-supply imbalance. But yeah, we're cognizant of it as the whole industry is at large. But yeah, gas is our focus, and we think that's the halfway house.
So thank you very much indeed to Andrew Dennan, and thanks for standing in for your chief.